Hey everybody, welcome to the Juniper Links channel. My name's Caroline and today I'm going to go over how to pay yourself from a limited company. So paying yourself is pretty easy, staying tax efficient is far more difficult, and I'll kind of explain why. So there's two ways to pay yourself. First is running a salary and the second is dividend drawings. So dividends are what you can take from the company after all tax has been deducted. So first we need to work out how much money the company has available. And what I mean by that is how much profit the company has after tax. And why do we need to do this? Well, dividends can only be taken when there is available profit to start with. So if your company is not making any profit, then you should not be taking dividends. And this is because if you do take them at that point, they're classed as illegal dividends, which can then be classed as a benefit in kind for tax purposes. And there's all sorts of tax implications that go along with that. It's just best to avoid that scenario altogether. And I've provided you with an example here. So we've got an example for now. £30,000 worth of turnover, £20,000 of expenses, including a salary of £8,000. So tax efficient salary is normally around the national insurance threshold and less than the personal allowance. And this is because once you start taking salary over your personal allowance, then you get taxed at 20%. Corporation tax relief is 19%. These cancel each other out. Then there's national insurance to pay, and it just doesn't really make sense to take more salary from the company at this point because you're just paying extra money in tax when you don't have to be, because you should be benefiting from the thing called dividends. Again, dividends come from company profit. So if we take this here, so 30,000 minus 20 is 10,000. Then we've got 19% corporation tax to pay on this £10,000 because that's our profit. So once we take that away, which is £1,900, and then we have £8,100 available for dividends. This is because we've taken into account all the corporation tax that you would need to pay on the profit and all of your expenses and everything to calculate the corporation tax in the first place. So this leftover money, the company is just sitting there in the company. There's nothing happening with it. You can just sit in the bank account as spare money. You can spend it on other things, or you can take out for yourself as dividends. And you can take dividends when you are a company shareholder. So if you own your own limited company and you're the only shareholder, then you are entitled to all of the dividends that that company can issue, basically. So once you take out this £8,100 and you've got your 8k worth of salary here that we took, and this is specific to the 18-19 tax year, then we've got basically your personal income for the year from your company. Obviously, if you've got other income, we need to add that up as well. So what about personal tax in this case? So there'll be no tax on your salary as under the personal allowance of £11,850. That's for the 18-19 tax year again. And then whatever is left over of that personal allowance, so £4,000 left over of your personal allowance, not quite, it's £3,850. That can be used towards the dividends you've taken as a tax-free amount. Plus you get a £2,000 dividend allowance. So in total we get tax-free of the £8,100 in dividends, £5,850. So all that's left is £2,250 that needs to be taxed, and dividend tax in the lower rate threshold is just 7.5%. And 7.5% of that amount is £170. So on this total £16,000 worth of income, you have to pay about £170 in tax. Just a note on the dividend tax, obviously it's not deducted through PAYE or anything like that where you get monthly dividend or something and tax is deducted from it when you take it from the company, so you don't have to worry about tax later. That's not how it works, so you just have to fill out a self-assessment every year. All that would happen then is you set up a transfer to HMRC for the £170 for the year. They've got a specific self-assessment section that you can pay them with, and that return and the payment will be due by the 31st of January 2020. So you've got about 9 months to pay that. That's generally how paying yourself from a limited company works. And to take out dividends and to take out the salary, so you need to run payroll for the salary, then you set up a transfer to yourself every month for the amount of salary you are due, or owed, whichever. And then for the dividends, you simply set up a transfer to yourself from the business account to your personal account. And ideally this will be done every 3 months. because it's a dividend payment, not a salary. So I've got to differentiate between these. Every 3 months you take out a lump sum dividend from the company after you work out the profits. And most of the time you can find a software to do this for you. So for example, the software we use, you would simply enter in all your invoices, you would enter in your expenses for any time period, basically up to date. So when you want to take out dividends, you just update everything to the date you're looking at taking them out. So invoices, expenses, salary's already going to be in there. And then the bank transaction. So if you took out dividends previously, we need to know that because it reduces the amount you could take currently. Once you're done with that, it'll spit out a figure for you after all tax has been deducted, or it'll give you a profit figure which you have to deduct tax from yourself. So just calculate 19% corporation tax and whatever the profit figure is to work out how much you can take from the company as a dividend. Thank you so much for watching this video. If you have any questions or comments, feel free to leave them down below in the comment section or contact us directly through our website juniperlinks.com. It'll also be on our screen here and you can find it in the description box below. Thanks for watching!